Welcome to Ask Me How I Know, multifamily real estate investing stories of struggle to success, where each week unscripted interviews with guests bring a fresh perspective to problem solving in the multifamily niche as well as feed your mindset. Success stories are great, but everyone knows the important part of the story, the part between the struggles of starting and arriving, and it often gets left out. Ask Me How I Know is like the back house of a restaurant. Pass through the prim and proper front of the house and join us in the harmonious chaos of the back of the house where honest, unscripted conversations take place and transformation happens. In life and investing, there are no shortages of wild scenarios, so no matter where you are in your investment journey, this podcast is for you. There is no pomp and fanfare here, just endless opportunity to build your investing and mindset playbooks. This is your retreat to breathe, build, and laugh. Welcome to Ask Me How I Know. I'm Julie Holly, and I'm happy you're here. Hey, welcome back to Ask Me How I Know. And today we have this awesome person, Brian Briscoe of Four Oaks Capital, joining us. And so, welcome, Brian. And Brian and I have actually been talking for, I think, 40 minutes now because that's just how it goes when we get on the phone together or something.
There's no short conversations between us. You know, they always go a long time. So it's fun.
Do. So hopefully the podcast won't go too far over for everybody. But the interesting thing is that how you meet people. And a lot of times we're all trying to network and meet the right people. And then you also want to make sure you have the right philosophies and the right ideas about how you're going about your business. And here I am scrolling over, putting, my big girl pants on, like, I'm going to go over and introduce myself at the Michael Blanc, website and on his Facebook page. And I do that. I post a little video and I explain, hey, I want to raise capital. I'm new to this and here's what I'm thinking. And lo and behold, who comments down below?
Yeah, this guy right here. So yeah, and it was we had been kind of affiliated with the Michael Blanc program in different ways for quite a while. I'm advisor in his Dealmaker Mastermind. So very frequently I'll hop on the Facebook page too and see what's going on. But Julie, I was just attracted to your enthusiasm. You're just so happy, enthusiastic, and energetic. And I saw it. And the other thing that we were looking for at the time, we're always looking for capital and capital raisers, and you said, I want to raise capital. I'm like, you know what? I might as well just give this a shot. Let's comment. Let's talk. Let's see if our interests align on something. And, I don't know, that was like 4 months ago. And
actually, you know what? I think that was almost not 10 months ago, like 8 months ago.
Yeah. Wow. That long already.
8 months ago. So, and then we had an opportunity to actually meet in person recently, at Rod Cleave's boot camp in Los Angeles. And so it's really cool when you see how this industry works and, you have different kind of gurus, for if everybody will go with that, and we all go to their different events or go to their different networking pages and you get connected up, but, breaking bread and, actually having somebody that's now real
people,
yes. Because real people. So I encourage everybody to, I'd love to see everybody comment, like, what are your favorite networking places? Where are you meeting people that you find are really valuable, that you guys can exchange value and add value to each other's ambitions? So drop that. Make sure you add comments wherever you're listening to this so that maybe we'll go to those places and check them out and other listeners as well.
Yeah. And I'll make another point is if you're looking to meet other people, you actually have to put yourself out there. What Julie did, it was like a 3 or 4 minute video. And, it was probably something that she was a little scared to do. I can imagine.
Brian,
yeah, a little bit.
I recorded that I don't know, no fewer than 200 times. That's only a slight exaggeration, just slightly.
Yeah, but you've got to put yourself out there. She recorded a video, probably felt vulnerable putting it on there. Here's my story. Here's who I am. I hope people don't judge, whatever. But she did it, and on the back end, in order for us to meet, I had to also put myself out there too. We scheduled a call. We talked to each other a couple of times. Then I put her in contact with a couple of my partners. It's like, hey, you like to raise money. Well, my partner Todd is really good at that. So let me get you talking with him, and let's see if he can give you some tips too. But that was basically the beginning of the relationship. Was she put a video and I responded to it. So yeah, absolutely, you need networks, but you also need to put yourself out there.
Yeah, you're
Um,
not going to go anywhere if you don't. And by putting myself out there, not only were we able to connect and meet, and that's been absolutely awesome because you're generous with your knowledge and sharing it and enthusiastic, but you also connected me up with everybody from Four Oaks. And that is where this story that we're going to lead into here in a moment, like that's where this comes about. I am so I'm probably like their biggest fan. In fact, Facebook actually said that I am one of your biggest fans
you
of
know,
Capital.
and I appreciate your being president of our fan club, I guess. No, but yeah, I definitely appreciate you. And I mean, we were at the networking event at the Rod Cleese thing, and I saw you and your husband walk in from across the room, and I was mid conversation. I just said, "Hold on, there's somebody I need to talk to," and I
Oh
walked. I didn't tell you that, mid
no.
conversation with somebody. I saw you walk in. I'm like, "That's Steve and Julie." I'm like, "Excuse me, guys, there's somebody I need to talk to," and I literally walked out of a conversation right in the middle, and just like, there you go. But
Thank you.
yeah, yeah, yeah.
It's I am like their biggest fan, and like I just love what you guys do. I love the in my opinion, you have to have everything aligned. You have to underwrite your deals in the right way that mirrors what our economy. It has to reflect what's going on with our economy, and it has to have a little crystal ball element to it to protect our investors. And ultimately we are protecting our investors. We say that we're going to do something and we have to stand and deliver. And at this point we don't know who's really going to perform because everything is so hot. And we'll find out when the tide rolls back, who's actually performing well. But I know who is going to be performing well because of how your approach. Four Oaks Capital, their approach to underwriting is conservative, and they're putting their investors first. And they've had some dicey situations come up, and they took the hit and they put their investors first. And anyone that's willing to do that are like my favorite people on the planet. Everybody talks about, how important their investors are, but you guys actually live and breathe it. So can we have a little
Yeah.
story time?
Yeah, yeah, we can tell a story. So, just about 6, 8, 10 months ago, I don't know, it was first part of May, we came under contract on a deal that we're still really excited about. It was in downtown Spartanburg, South Carolina. And Spartanburg is it's on the I-85 corridor between Charlotte and Atlanta. And in the Southeast U.S., those are two of the hottest cities. And that corridor between the two cities is one of the biggest growth spots in the Southeast right now. So, upstate South Carolina, and then Spartanburg was recently named by the U.S. Census as, like, I think the 19th fastest growing city in the United States.
Uh,
Um,
Everybody listening, taking note of that right there. Like,
yeah, I mean, 19th fastest growing city in the United States. Okay, and it's just this little town that not very many people have even heard of. And then our apartment is in downtown, and oh, by the way, the city's doing a big revitalization effort to make downtown beautiful again. It used to be a rail city, and it still kind of is. I mean, there's an inland port, and there is a lot of railway activity going through the city, but they're taking all the old warehouses in downtown, turning into breweries and restaurants and Class A apartments and things. So you know, we got a really good location. It's an older building that was maybe a little bit neglected, and it's still the only building in downtown Spartanburg where you can get an apartment for less than $1,000. And when we bought it, the average rent point was about 750. So there's a lot of room to move up. So we really loved the deal from the get go, and very fortunate to have been in the spot where we were for it to fall in our lap. And to get there, I won't go into the backstory, but it basically took a lot of hard work and effort, a lot of cold calling, a lot of underwriting, a lot of effort, and then finally this one fell into our lap. It was just like, oh, this is actually a really good deal, diamond in the rough. So, we put it under contract. $4 million for 55 units. So we're about $75,000 a unit. And from the beginning, the lending was a little bit of a challenge. It was what we call debt service compressed. So we went in underwriting at a 75% loan to cost. Our broker had kind of looked it over with us and said, yeah, we can probably roll in some of your renovation expenses with it. So our initial numbers, we looked at it and we said, okay, we're going to need to raise about 1.5 million on this. And so we go through due diligence and everything else, and we're starting to do everything that we can to make sure it's still a good deal. We find a couple of things that are a little concerning. That the roof was a little older, and not in great condition. Had it inspected. Turns out it still has several years of useful life. We actually had, I think, 6 different roofing contractors up on that roof at various points. Found out that the plumbing, is old. There's still some cast iron plumbing in there, so
Wow.
it was built in the 30s, so it's a very historic building, but yeah, there's still cast iron plumbing in there, and we know that's going to cost us a little more. So we went through the whole thing, but end of the day, when we're talking with the lenders, they weren't going to quite be able, once all the numbers came through, they weren't going to quite be able to give us the amount of proceeds we needed. And we're like, okay, that's not a big deal. So instead of 1.5, we said 1.7 is our number. Okay,
$200,000.
yeah, going from 1.5 to 1.7, at that point wasn't a big deal. So we apply for the loan, and we get a smoking hot interest rate. The loan application says 3.9%. And we're just like, oh my gosh, guys, this is killer. But our broker tells us,
come upon us.
yeah, 3.9%. It was a 12-year loan, and like, really? We're going to lock in a 12-year loan at 3.9%? I'm like, absolutely. But the broker told us, and it's a Fannie Mae loan, and it's true of every Fannie Mae loan, you don't lock the rate until right before you close. So you look at our loan application paperwork, and we were going to get about $3.3 million in proceeds, and we're thinking, awesome, this is amazing, 3.3 million, and as we're going through, the lenders doing their underwriting, we're doing our underwriting. There were a couple hiccups here and there, like the lender, when they first did their comps, they came back and said, your comps are, your rent projections are way too high. I'm like, no, they're not, and we started looking at it. I said, so we ended up getting the comps that the lender used, and there's a big difference between downtown and 5 miles away from downtown. And they were just using comps from the city of Spartanburg, and it's just like, yeah, but we're downtown. We're walkability score of 80 at this complex. They can walk to like 15 different restaurants within 3 blocks.
And that's a huge thing when lenders are looking at comps and they're not actually feet on the ground and they're just going off of general numbers instead of actually like, hey, we know exactly where this is and this sub-market. Yeah.
Yeah. And so we fought back on that one and we won, and the lender came back and said, you know what, you're right. We provided them a couple of comps that were a little more specific and that were apples to apples, and not apples to oranges in the case. And they came back and said, okay, you're right. We can still give you, that number that we said earlier. We can still give you the 3.3 million, so, once again, fat and happy, we're everything's trucking. And I'm not saying it was easy. There were a lot of little hiccups along the way. Don't think you're going to get in there and get a rose garden, or maybe you will get a rose garden, but lots of thorns in a rose garden. Looks pretty from far away, but you get walking through it, you're going to get pricked a couple times. But anyway, we had a close date. We were going to close, last week of September, and everything was going along just fine for that. And if anybody was paying attention to the lending what was going on with multifamily lending in September of 2019, Fannie and Freddie, they're federally regulated, and they have a cap on how much money they can put out. Because interest rates had been so low, so many different apartment owners had refinanced their loans. Both Fannie and Freddie were reaching their cap. They were super close, and the federal government came out, and I mean, Trump even tweeted about it. Trump tweeted that Fannie and Freddie shouldn't be regulated by the feds at all. Personally, I agree with that one. But end of the day, Fannie had some government regulation that they had to meet, and they had to slow down their lending. So what did they do? They artificially raised their interest rate. So, we were, and rates had fluctuated, and we were looking at our rates. I think at the time, there was a time where we were at like a 3.7, 3.6, and Michael Blanc told us that I don't remember the exact number, but I think they locked and got a loan at 3.58, 3.59, a week before, what I'm going to tell you about happened. So, I mean, rates were ridiculously low. But in order for Fannie to slow down their lending, they jacked their rates up. So within a 3-week or within like a 3-day period, our rate went from a 3.9 to a 5.1.
My gosh. Every time I've heard this story, but like every time it hits me just as hard. It's like,
Yeah.
Oh. And I remember everybody freaking out in multifamily at that time last year, with all the fluctuations, but 3.9 to 5 over, like, oh my gosh.
And we were just like, oh, I mean, I got a call from my attorney. He's like, hey, I'm at this conference with our broker. They're both out of Dallas. He's like, I'm at this conference, and she said that your guys' proceeds are going to take a hit. I'm like, how much? He's like, I don't know, but it's a lot. He's like, so I'm just calling you to prepare you. You need to talk to her. You guys need to be prepared to take a big hit. So I get on the phone with her, and this is before I knew what was happening in the lending scenario. I just didn't realize how dramatic it would be. We went from 3.3 million in proceeds to 2.6, and that's a $700,000 swing. Now, in the course of what happened next, we were able to get it back up to 2.7. So we were able to get $100,000 added back on the proceeds by basically playing a shell game.
But this is where I was like already a fan of every one of you, Brian, Todd, Eric, and Brian. I was already your biggest fan, but then when this happened, I was like, these guys are head and shoulders above everybody else. Like,
yeah, so I got the call from our attorney. I'll throw his name out there. I almost said it anyway. Dugan Kelly, great guy. If you're looking for an SEC attorney, look him up. Kelly Clark Law. I'm sure he'll be happy to get the plug from you. But and end up talking to the broker as well. And I was sick. Sick to my stomach. It was just one of those things where, I was kind of like moping around the house, just thinking, oh my gosh, what are we gonna 2.6 that? What are we going to do? And it was probably a full day before I even told, my 3 partners. It was just like, what are we going to do? Trying to figure things out. And I reran the numbers, and the numbers just didn't work. We were advertising a certain return to our investors. And with this change, we would necessarily have to raise more capital, which dilutes all of the returns. So our capital raise went from 1.7 to 2.2 million. So now we would be able to pay the exact same returns, but diluted. So the returns dropped by about 5%, and we already had, we needed 1.7, and we had 1.4 committed, so we were in a great spot. We're still a week or two away from closing, and we went from a great spot to, I don't even know if we can close, is basically what it came down to, so we started looking at the numbers, and what we didn't want to do is call everybody and say, hey, I know we advertised X percent. Just kidding. It's going to be 5% less. So We already
Yeah,
have your money in the bank. We're going to keep it.
yeah, great way
We're
to
absolutely,
tarnish your name forever. Like,
I know. And we were absolutely not going to do that. So, it took us a couple of days to figure out what the solution would be, and we probably spent a couple hours on a Zoom call together, just brainstorming what can we do
mhm,
to make this thing still work out. First of all, we looked at it like, do we still like the deal at these numbers?
right,
You know, and you know, you always hear that the three most important things in a real estate deal is location, location, location.
right.
We still like the location. We still like the deal. All right. But what we didn't like is, having to go back to the investors. So we started looking at ways to get back to the same percentage that we were at. We had offered a 6% pref. So investors get the first 6% cash flow that comes off the property. And then after that, after we met that hurdle, we were doing a 75-25 split. So investors get 75% after that. And, the managing partners, us, would be getting 25% of cash flow. So we looked at a lot of different levers, and there's lots of different levers you can pull in each one of these deals. And we got on the line with, we have a couple mentors that we can go back to. I was a Michael Blanc coaching student at the time. I called my mentor. Todd called his. We had lots of conversations, and at one point, one of the guys that partnered with us as a KP just suggested, he's like, "Hey, have you guys tried changing the equity split?" And we're like, no, we haven't actually. We had tried so many different things. We tried taking away our acquisition fee. We tried, you know, raising the pref. We tried a lot of different things. And so I had the spreadsheet open, I was looking through it, and okay, we're at 75-25. I tried 80-20. Okay, it moved the returns up to the investors a little bit. 85-15, not quite there. When I got to 90-10, the investor return number was back to where we had advertised previously. And so when we saw that, we're like, okay, that's what we're doing. And all four of us agreed. It's like, that's what we're doing. We still like the deal. um we think it's a good deal for our investors. um so let's not back out of it. Let's just change the structure so that we make less. So we basically diverted a lot of the extra funds off the deal into the investors' pockets, just to keep the interest rate, just to keep their expected return the same. And then what we did is we got on the phone and we called every single one of them. We said, "Hey, this is what we did. We had this problem come up, and I'll tell you what, I was scared. I was scared that we were going to lose people.
Why did you
And
think you would lose people over that?
I don't know. I mean, at the time, it was just like we were worried about a lot of things.
Right.
Maybe this was like our little doomsday scenario, and from the beginning, we were worried that this would lose people. Just going from a 15, I think we're advertising somewhere between 15 and 16%, and this dropped us down by 5. But just going with that change and saying, hey, this still isn't as pretty as it used to be because the bank's not giving us a lot of money because I didn't know how that would sit with everybody, but we picked up the phone, we called every single one of our investors, um, and every single one of them stayed in, and, we got back on the phone a couple days later and like, yeah, everybody's still good, and the feedback we got was more, much more positive than we expected, I was happy with just neutral feedback. Like, yeah, sure, I'll still stay in. But to a T, everybody that I called was like, "Oh my gosh, I can't believe you guys are doing that for us."
Right.
And it's just one of those things where it just re-cemented in my mind that when you put the investors first, it's it's good for business. You know, but I wish I was thinking about that when we made the switch. That this is, we were just trying to keep the deal alive. We have a lot of people that we know who were advertising deals at the time, and when Fannie raised their rates, I got a slurry of emails that said, "We're cutting and running. We're cutting and running. We're dropping this contract." And there were a lot of people, and that's exactly what Fannie wanted. Fannie and Freddie both wanted, people to come out to drop their contracts so they wouldn't hit their limit.
Yeah.
And there are people left and right who were backing out of contracts because of it. So,
And
um,
that creates a whole different problem for our investors. I mean, I know as a passive investor, like when when we're like excited about something, we're like so stoked, like, yes, we're part of this. And I mean, just that part of knowing that your money is going to be working somewhere as a passive investor, and to vet a deal, it actually takes something on the LP side in order
Yeah.
to like actually say, this is the deal, these are the people, and this is where my money's going to go. So, like, to cut and run on your investors, actually is a huge disservice to them. I mean, I'm saying if the money, I mean, the money has to make sense, but
Yeah.
I mean, I love that you guys you put your investors first,
I mean, there were a lot of reasons to stay in the deal, and like you said, the deal still had to make sense. If that change would have taken it from a good deal to a bad deal,
No,
that would have been a different conversation with the investors.
right.
And it'd been like, hey, this is what happened. You can Google, you can Google, you can just check the local financial news and see what's happening. This is what happened, and now this good deal is all of a sudden a bad deal.
Yeah.
So we ended up we ended up at the point to where, like, we had 1.4 million committed, but at the time we had about 1 million in the bank. We had a couple of people who were moving money from retirement accounts to self-directed retirement accounts,
Mhm.
and that takes a while. But um, before the interest rate swing, our broker was telling us we needed about 900,000 to close. So the 900,000 to close, would have paid off the owner, and then everything past that was, paying our attorney, paying, a couple other things, and then the renovation budget. So everything we were raising after the 900 and something thousand. So that number went from 900,000 to 1.4. It ended up being 1.43 is what we had to bring to the table at closing. And we had 1.4 committed, but only 1 million in the bank, and we
Yeah.
had two weeks left on contract, and we were just like, okay. So now we figured out how to make this work for the investors. We figured out how to make this deal work. We still had the problem of we needed to get $400,000 in the bank, you know. So we ended up taking a trip down to South Carolina. We had another deal under contract, and we were going down anyway. So we were doing due diligence on two different properties. That's a whole different story. We put out a couple LOIs, thinking that there's no way we'd get all three of them accepted, and we did. We got 3 LOIs accepted in like a 2-week period, and it was just like, oh my gosh.
Go big or go home. Man,
Yeah,
that's a good problem, right?
and that's what we said as we were doing. We were like, what happens if we get all 3 of them? Well, that's a great problem to have. We'll figure it out. So we were down there on a due diligence trip anyway. All 4 of us, and we met with the broker who was who brought us this Spartanburg deal. And we basically just laid it all out on the line with them. We're like, hey, here's where we are. We still want the deal. We just need more time.
Yeah.
Do whatever you have to do. And here's the deal. At the time, the broker doesn't get paid unless the deal goes through.
Yeah. Boy,
So their interests were completely aligned with us at this point. We're like,
right.
we still want the deal. Can you buy us some more time? And oh, by the way, what's that?
If you don't mind, like, I don't think I've ever asked. I know, like, Michael Blanc really pushes, like, make sure you have extensions built into your contract. If you don't mind, you're on the spot. Did you guys have extensions in there?
We had one 30-day extension, and we had actually already burned it.
Okay.
The lender had taken, so they advertised 60 days, for a Freddie or Fannie loan.
Right.
At this point, we were at like the 75, 80-day mark after we put the loan application in. And I mean, had Fannie Mae been faster, we would have closed before this happened, but there were a lot of things, and there were a couple of points in the process where we slowed things down. We were the biggest, at every point in the process, we looked at this deal. If we had something, that we needed to think about or work through, we said, hey, we have time, and so we took our time at several spots, but, we didn't anticipate this would happen,
Right.
but we had already burned one 30-day extension. We were on track to close at the right time. And so we were up against the wall on, our contractual, we already burned through the one extension that we had.
Right.
And so, we were talking to the brokers and we're like, hey, you need to convince the owner to give us 2 weeks.
Yeah.
We need 2 weeks.
And at this point, the owner also has an interest. I mean, to go back on the market and to wait through a whole nother, marketing period and then under contract period, like the owner has a buy-in, but you have to have a good broker to explain that and to sell it and present that. Yeah.
Well, also at this point, I mean, look at the other end. The owner had $100,000 in his back pocket from us. We had our earnest money deposit in, and we had our extension fee already in. So if the owner said no, he walks away with $100,000, and we walk away with nothing at this point. So
True.
And we were keenly aware of that. The broker was keenly aware of that. And so we basically put it in the broker's hands and said, go fight for us. Yeah. And they came back to the table and said, okay, the owner is willing, but it's going to cost you. And so far, like, your earnest money deposit gets credited towards the payment, so not a big deal. Your extension fee gets credited towards the payment, not a big deal. The owner basically asked for a $20,000 fee that wasn't tied to the payment or applicable to the down payment or the purchase price. So it ended up costing us $20,000 to extend it for 2 weeks, but it was that or walk away. And once again, we threw that into our numbers, okay, it's going to cost us an extra $20,000,
right?
And that's a drop in the bucket. That's like,
yeah,
0.5% of the purchase price, we paid, we paid bigger fees to our lender than that number. Our attorney fee was right in the same ballpark, so drop in the bucket at that point, and we're like, okay, yep, we're going to do it. So signed the paperwork, bought us 2 weeks. We did reach out to some people that we knew through the Michael Blanc program. A guy named Hutch that I really, really appreciate in a lot of different ways. Reached out to him and he said, hey, I know a couple people that I think can invest. So we brought Hutch into the general partnership, and Hutch came up clutch for us. And
Does he have a T-shirt that says that now?
Yeah. So I'm going to buy him a hat that says, "My name's Hutch, and I'm clutch," or something like that. But he brought a couple of investors to us. He ended up bringing, I don't remember the number, but he invested some of his own funds with us. But in that 2 week period, each one of us kind of dug into our back pockets. I already had $50,000 in the deal. I ended up putting 80. Eric and Brian and Todd all had money in the deal already. So we all dug in our back pockets a little bit more. We contributed more funds to the deal. Went out, called everybody we knew, everybody that was on the fence before. And long story short, in that 2 week time, we went from $1 million in the bank to 1.4. And we were able to close.
Did you happen, someone I spoke with recently who ended up needing to go back and raise capital, was explaining the second sale. And so they went back to their investors because they'd already invested and they'd already believed in the deal. But they actually had a lot of people in kind of, increase their investment level. Did you have any of that, or?
We talked about it. And I do know a lot of people that do that. A lot of people that will throw it back out to the investors and ask for more. I don't remember our logic behind it, but we decided to not try to do it. I think we were
you guys have experienced a lot of trauma, actually, so maybe you're like
we had just gotten out of crisis mode. It's like, okay, we kept all of our investors. The last thing we want is to make them think we're in a crisis, and we were probably in a little bit of a crisis at the time. But we were looking at optics at that time too. Could we have gone out to the investors and probably gotten a little bit more money from a couple of them? Probably is the answer. I don't remember our logic behind it, but we decided, we thought we had a road to 1.4 by closing without a problem. We talked to our attorney, we talked to the brokers, we talked to everybody. Our attorney basically said, you can still raise after you close. That's not a big deal. Not optimal, but you can still raise after you close. He's like, you can raise up to 6 months after you close. on the same, SEC allows that. He's like,
Yeah.
and even after that, you can still open it up to a second raise later. You can do capital calls. He's like, even if you don't hit your mark in 6 months, there's still ways to get you to your fully funded amount. So so we went with that. We had enough money at closing, and we still had several $100,000 in commits that hadn't deposited yet. And so, I mean, since then we basically, 50,000 here, 80,000 there, nickel and dimed our way back up to where we're at. So
That's what
yeah,
this takes. It's like it's hustle. And you
yeah,
don't know when the wild card is going to be pulled. And so you just throw the hustle in there.
yeah, and there's a couple other things like I was on Michael Blanc's podcast 2 weeks ago, and at the time we needed about $100,000 left. I had somebody call me after hearing me on Michael Blanc's podcast and say, if that's still open, I want to invest. And then all of a sudden I have like red lights flashing in my head because there's some SEC rules on a 506B, 503, whatever the number. Yeah. So we did not have a pre-existing relationship.
Right.
He's coming to me and saying, I've got X amount of money to invest, and I'm looking at our numbers. I'm like, that tops us out. I'm like, well, absolutely, I want you in the deal. So there's nothing that goes against the pre-existing. We did not have a pre-existing relationship. He heard me talk about a deal on Michael Blanc, which could be construed as advertising, which you're not allowed to do, and called me up and said I wanted to invest. I'm like, shoot, that's against SEC regulations. So I call the attorney, and I'm like, hey, how can we do this?
Right.
And the answer was, if he's a GP member, that I mean, I'm not going to go through all the details, but
Right.
we basically found a path to stay within the regulations and bring him in as an investor. So more complicated than I'm going to say, but basically he's a GP member now. So the pre-existing relationship doesn't apply to him because he's one of the managing partners. But at the end of the day, we're going to find a way to do things right. We're going to find a way to make sure our investors are taken care of, because it's a reputational thing. If we punt on any one of our deals, we're basically burning bridges with those investors. And ideally, what we want to happen is, 3, 5, 6 years from now, when we sell any one of our deals, we want these people to take their proceeds and put it right back with us.
Yeah.
We want to be able to offer them a new deal and just say, hey, you put in $100,000 on this Spartanburg deal. We gave you 200. You just got a whole big lump sum back. Guess what? We have this killer deal in Atlanta or Charlotte or Charleston or whatever.
Yeah.
Why don't you invest with us again? So at the end of the day, we basically, it's good business. It's just good business. But end of the day, it's a relationship thing. We want to make sure that our investors are confident with what we do. We want to make sure that they know that we're going to take care of them at our own expense. And oh, by the way, there's an asset management fee that we rolled into the Spartanburg deal. We haven't taken it yet. It's 1.5% of all proceeds to pay us for managing it, for overseeing the renovations, for doing all of that. We haven't taken the asset management fee yet until we're sure that we can meet that pref. We have a 6% pref that we're supposed to hit, and if we're taking 1.5 out of the deal, and that 6% is questionable, we'll suck that one up too. But
and a lot of people, in this again, I always every time I talk to you, I'm always like, I just love how you guys do business. Any of you guys, whenever I talk to any 4 Oak member, I'm just like, I love how you guys, operate and run your business, because it really is, it's investor forward. And because you're not just looking at your back pocket right now, you're looking at everything, and let's have this relationship. I mean, you guys are similar to our company in that you call it, your investor family. Like, this is family.
Yeah,
it's important. It's important. I love that you guys find all these solutions, because the reality is that, like, the moment you are in a transaction, and it doesn't matter if it's multifamily or any other type of business transaction, you enter into a contract, you're running the gauntlet and you're going to
Hmm.
get hit by, you don't even know what's going to come your way. And you guys land on your feet every single time. So you have a situation where, you have this interest rate situation, and now, golly, you got to raise like hundreds of thousands of dollars more. How are we going to do that? But what stands out to me repeatedly is that and it's what you were saying earlier, is that you have to put yourself out there. And
Hmm.
so you guys put yourself out there, and instead of holding up and just trying to solve everything on your own, you guys reached out. You have a network, and you reached out to your network and you said, all right, we're in trouble. And a lot of people have too much ego to admit that they're having a problem. And so, you guys really are putting your investors first, and you're saying, hey, Houston, we have a problem. Like,
Yeah.
and you have this, all these different eyes giving you some suggestions. Like, we can't do this alone. Everybody says that like multifamily is like a team sport, but it really is. And then to have your broker, I'm going to touch on that now because
Hmm.
I hadn't heard that part of things before in the past, surprisingly. But having that right broker, like, you have to be working with the right broker in order to know that they're going to be able to go to bat for you and win.
Yeah.
So
And that brokerage team, honestly, they took a chance on us. They really did.
the newbies.
Yeah, we're noobs, and it's so hard, as a beginning syndicator to get brokers to trust you. And, you know, we talked about a million things, when we were worried about this deal falling through. And, one of the things that came up was, you know, the brokers also went out on a limb for us. If we pull out of this deal, we're also letting them down, and that
Yeah.
there were so many people who had helped us along the way and done everything, you know. These weren't, these were all, you know, extra little reasons. None of them were primary reasons why we kept on with the deal. We kept on with the deal because it was still a good deal. But as we're doing it, we're like, we just didn't want to back out. We looked at all the reasons, all the people who had helped us. The broker, number one, they had put in so much work on this as well already. And just them giving us the time of the day as new investors, new syndicators,
Yeah.
putting this deal in front of us. It was like, hey, we got this. And um, I tell you, there's a lot of hard work getting in there. Um, I live in DC. I got in my car and I drove down to South Carolina, 7.5, 8 hour drive to meet these guys. So I definitely put myself out there. That they had a deal that they were running and we were underwriting. And I said, hey, I want to come down and look at that. Okay. So we scheduled an appointment, and it was while I was down there that this deal came up. They said, hey, we just signed with an owner last week. You know,
Mhm.
we haven't even put a deal packet together yet. Do you want to go look at this? So yeah, I mean, number one, they took a big chance on me, but they probably took a chance on me because I was willing to get in the car, drive down to South Carolina with no promise of any reward,
Yeah.
and meet these guys, walk a couple of deals with them, talk with them, break bread with them. And, at the end of the day, we ended up putting offers in on both those properties. But, you know, so yeah, I mean, they definitely went out on a limb for us, just bringing us into the fold.
Well, golly, you're bringing even another solution to the table, and that is, for the new syndicators out there getting into markets that, they want to breaking into a market is a better way of putting it,
Mhm.
right? But they like going, like you're saying, like, you've got to go put feet on the ground and put yourself out there and
Yeah.
make them real people, have that real connection.
Yeah. Real people. Yeah.
They gotta
Uh,
become real people.
now for you and me, that's kind of an inside joke, but I think I'll probably explain it to everybody else. I
Yeah.
made the comment to Julie a while, like when we first met in Los Angeles face to face. I made a point to say, you guys are actually real people now, and not just somebody I know over Facebook, which could be, could be anybody posting a profile picture, and saying they're Julie Holly, but so Julie's now a real person. That's why we keep on bringing that. But
Flesh and
real
blood,
people,
real
flesh
broken
and blood. Yeah, you're a real person now. Not one of those fake Facebook people. So
everybody
real.
needs to get out there and make people real in their life. Go to those networking events.
Yeah, I mean, meeting people, on your phone with your thumbs is one thing, but get out there. Go meet these people. Offer to buy them coffee or buy them lunch. And I would offer brokers, hey, do you want to meet for coffee? I'll buy you coffee. And quite frankly, most of the brokers said no. It's just a time suck for them.
Right.
One of the brokers actually explained to me, he's like, I get probably 20 calls like this a week from people who've never done a deal before. If I met everybody for coffee, I wouldn't have time for anything else. And he refused to meet with me. He's like, I'll talk to you on the phone. That's it.
Yeah. There's truth to
that. There's a lot of truth to that. And I respect him more than the guys who said, yeah, well, I'll send you something, and then just never did anything. But so what I did is I would send Starbucks gift certificates in an email to these guys and said, hey, sorry we weren't able to meet up for coffee, but I promise I'd buy you a coffee. Here's a $10 Starbucks gift card. And it's just one extra thing. I was looking at ways where I can make them remember me and give them a reason to take a chance on me.
Yeah.
Driving to South Carolina. Okay, I offered to buy them lunch. They didn't buy me lunch. I offered to buy them coffee. Offered to buy them coffee.
Yeah.
Okay, so here's your gift certificate because I said I was buying you coffee. So here you go. And that got responses 100% of the time.
Yeah.
Just sending emails to brokers got responses maybe 20% of the time. I probably spent $100, $150 on Starbucks gift cards or the little online email the gift certificate out. So
it's amazing. It doesn't take much to make a big impression on people.
Yeah. So
well, Brian, I really appreciate your time. I always enjoy talking with you, and I love the heart and the mission and vision behind you guys at Four Oaks and what you're doing. So keep doing it. If you have not connected up with and checked out Four Oaks Capital, you just need to run over there right now. They have a great Facebook page. It's fantastic. But I'll leave all the little clicky links. We're not going to go through all the typical, here's how to reach Brian, but I'll leave all the numbers. I'll give you his private number so you can text him. But we'll leave it down below and you guys can connect up. But make sure you do, because finding, good syndicators who you can trust, that's worth its weight in gold right there. So
thanks a lot, Julie. I appreciate you and everything you've done. So glad that you posted that video, 8-10 months ago, however long ago it was,
That's so crazy.
Yeah, I know. So
I was thinking about the timeline because the listeners don't know this, but when we were talking, you were talking about, how many millions you have been able to raise. Four Oaks has raised in the last 10 months. And so that's what got me thinking actually, that I was looking at that timeline. So you guys are crushing it, and 2020 is just going to go continue to rock for you guys. Yeah,
we're raising for deal number 4 right now, and we're somewhere right around the $3 million mark as far as what we've raised from passive investors. So we're excited to see what 2020 brings. We've got some lofty goals, and we got a lot of work ahead of us. To be honest with you, so 80 units under contract, and our goal for 2020 is 500. So somewhere along the line, we got 420 to go. And it's February 8th, so we've got just under 11 months to do it. Plenty of time.
Plenty of time.
Yeah, that's like what, 40 units a month is all we need to do. No big deal. We got this. So.
Oh my gosh.
Yep. All right. Well, thanks a ton, Julie. It's awesome.
Thanks so much for joining me for another episode of Ask Me How I Know. My guests are the most humble successes, so be sure to show them your appreciation by rating this episode 5 stars, which sounds silly, but let's be real. Ratings, likes, and shares, they take no time at all, but make all the difference in the world, if only to boost morale. Also, since I don't spend time on the how and why they got into investing, be sure to check out the show notes to get to know more about today's guests, including other podcasts they've been on that has a more traditional format that will give other details about their investment journey. It'll also tell you things like the most influential person in their life and what they're reading right now, as well as how to connect with them. And please, subscribe and rate Ask Me How I Know so it reaches other listeners like you. Until next time, go find your freedom.